Welcome back to another episode of Investing Explained. Here's today's question.
In general, barring one's status as a professional who knows exactly how and what they're doing, I wouldn't recommend shorting anything just because it's a dangerous game. In general, when you short the S&P, or let's go back, when you long the S&P, what do you get? Well, typically what you get over the last 100 years is you're going to get the risk-free rate, let's say 10 duration bond return, plus 300 to 400 basis points, which is what they call the equity risk premium. So the premium for holding risk. Historically that's been, around 9%. Nowadays with, 10 years at like 2.25 plus 3 or 4, that's maybe 6% or something, right? So that's if you're long the S&P. So when you short the S&P, you're eating that as a headwind. So the benefit of shorting the S&P is obviously if the market blows up, you gain, or if you have other long exposures in the rest of your portfolio and you want to hedge out kind of what they call the market risk or the market beta, you can get rid of that risk. However, it comes at a huge cost. It comes at the fact that now you're essentially paying, the risk-free plus 300 to 400 basis point equity risk premium. And that's now not a tailwind, but a wind in your face. So I would avoid in general, just don't short equity markets. If anything, just sell down your stocks if you can't handle it.
Yeah, I would completely agree with you, Wes. I mean, it's not only a question about not shorting equities, it's probably a question about not shorting anything unless you really, really know what you're doing. And in that case, and if someone would be interested in an approach like that, I think that for some types of investors, it might be beneficial, say, shorting the S&P 500 and going long individual value stocks. That is an approach that one can definitely take up. It is definitely a risky strategy. It's more like a hedge fund strategy, and you might only want to do that for a part of your portfolio. But the reason why I bring this up, and it's not necessarily something I recommend, but I just want to bring this up because what Wes talked about before in terms of beta, in terms of how is that related to the market, that might be one way of, if you think about it, you were taking away the stock market risk, because if the stock market should drop with, call it 20%, and your pick or across the board of your picks might drop only 10%, you will actually make a gain. So that is another way to be investing in the equities market. That's definitely, by all measures, regardless of how you're going to measure it, is overvalued at the moment.
Yeah, and that's actually a great point. And you're just, again, highlighting that if you do it, it's going to require another level of sophistication. We actually have an old article. It's called Creating a Tax-Efficient Hedge Fund. And essentially what you mentioned there, Stake, if you believe in value, but you don't want to deal with the equity risk, a DIY hedge fund is, go buy individual value security names, short out the S&P risk. So now you're basically spread betting between what you think your value stocks are going to do relative to what the S&P is going to do, but you're not like exposed to, if the market blows up 50%, that's going to be painful. Now you're just exposed to how well your stocks do relative to, S&P stocks. So, and you're basically creating your own hedge fund. But to the extent you don't even know what a hedge fund is, or you don't know how a hedge fund works in a portfolio, you definitely shouldn't be creating a DIY hedge fund, because it's just, piling bad things on top of more bad things. But it can be a really powerful thing. But in general, it's just, you probably want to avoid it unless you kind of know what you're doing, or you're willing to invest some time and education on it.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.